Hey, what's going on, folks? This is Dimitri back again. In this video, we're going to discuss how to avoid common mistakes while or when you start investing or become investor. And save thousands of dollars. I'm telling you, thousands of dollars every single year. Can you imagine? Every single year, investors lose thousands of dollars, not because the market is bad, but because they make mistakes. And that's what we're going to talk about. So 6 mistakes that we're going to discuss, and I hope you guys enjoyed this. Like and subscribe down below and let me know in the comments below what mistakes you made or trying to avoid or avoid it because of this video. So mistake number one is panic sale. Panic sale is always happens when something happens in the trading world. So when you invest, when you go and hey, you invested, okay, I'm happy, I bought my stocks, I bought my whatever, and I hope my money grows, and because I did my research and everything, and I'm sure this company is good, and the finances are good, so we good. And then all of a sudden something happens, and there we go, panic sell. Oh my God, what did you do? I don't want to lose this money. I don't want to do this. I don't want that. So selling investment when market drops. This is a common mistake because the fear infusion of a lot of people who's doing that, and it's a hype, it's everything so that you can possibly imagine, but the cold-headed understanding of like, hey, this is the market and this is the panic and this is it. So why it hurts? You lock yourselves in losses and miss rebounding when that happens. So that's exactly what happened in 2020 when market dropped and there was a rebound. So a lot of people basically lost their money. So what happened? What is that they invested, they were doing investments, everything was nice and good and nice and shiny, and all of a sudden the market dropped. They're like, oh my God, that's it, I don't want to lose everything, so I might as well sell everything. And all of a sudden, boom, a few months later, actually 3 months later, market rebound back again, and all of a sudden, oh my God, I need to go back and invest again. So in that period of time when they like went all the way down, they did what? They lost money. That's what happened. So, and because if you wanna avoid that, here's the insight: timing the market is wrong. So time in the market is correct, is good. So and that's here's the difference. So you're trying to catch that drop or rise or whatever. That's what happens when you gotta, like, when something happens like that. So, and timing the market is when you trying to enter in the right time. So, and that's rarely happens. And so for that, there are good options to partake that, and there's the different strategies and all that. So, but not going too deep into it, but time in the market. So if you invest and take there a long time, and that is like cooking and marinating and all that, so that's the key, because it doesn't matter like, hey, something happened, company, you know your ins and outs, you know your insights in the company. How you might know that? By reading the papers, the tax returns and everything like that, that's published in their investor relations investors. So that's basically how you avoid that feeling of, hey, I gotta sell and panic and all that. So have the knowledge. That's the key, right? So have the knowledge about the company which you're investing in. So mistake number 2, chasing hot tips. And oh my God, there's a lot of that in the world. So meme talks, TikTok stocks, every stocks like hot, let's short thing, whatever thing, picks, whatever, all that. So this is a hot one, all that. Forget all this. Why? Because that's the thing that they're trying to do, is that they hype this thing up, and then that's how these guys making money. So everybody who is hyping something is making money that way, because he invested, and then now the time's for hype. Now they hype it out. Everybody's start investing. The price is rising, obviously, for the stocks, for whatever stocks. It might not have any like financial statement, financial ins and outs for that. But then when the hype is over, when there's like, all right, this is done, boom, they sell everything, and the hype somehow dies out all of a sudden, and a lot of people lose money. So when they were like buying on the rise. So that's like exact definition of meme stocks, TikTok stocks, sure thing, whatever thing. So you guys, so why it hurts? Why it hurts? Because you buy when it's rising on almost at the high, and then you sell when it's low. So obviously when you bought like something for $100 and then you sold it for like $1, you lost like $99. So that's basically the value of that purchase. So you know, it's so it's unfortunately it's there, so avoid that mistake, and I hope it's not going to happen to you. So mistake number 3, ignoring the power of compounding interest. So a lot of people just don't invest, you know. Some people just, you know, whatever, I don't care about that, so I'm not going to invest anything. So this is a 100% a miss out on compounding interest and the power therein. So right, so when you invest and then it's growing and it takes root and it is growing more. So as you invest, as it sits in there, so it gives more and more and more and more. Prime good example is when you invest like with dividends, you reinvest the dividends again, right? So it's rising, so it's like over time, over the months, over the years, that investment portfolio is growing. Because why? Because company is paying you back, and then you reinvest again, and then paying, yeah, reinvest again. So it's kind of snowball effect. So, and that's the percent, like you know, like key thing that very, very nice. And snowball effect as a visual and invest in it, or like check it out, it's amazing thing. So it hurts because you miss the snowball effect. That's the key missing there. That's the key mistake. And to avoid that, right? So if you start early, if you start investing, whenever you start investing, it's good. Well, but you got to approach it with the, you know, as a smart cookie, so to speak. So think of it like take time and do your homework. I mean, it's tedious, it's hurtful, but on the other end of the research, on the other end of homework, is basically a reward, right? So that's basically it. So avoiding that is the mistake. Mistake number 4, no diversification. I can tell you good example and bad example. Good example is you diversify, or you know, you don't do diversification, you invest everything in Bitcoin, and boom, Bitcoin is awesome, right? So it's you know, hit or miss, right? Well, it's hit in this sense, but in this sense, if you don't do diversification and invest in something like whatever, you know, office in somewhere nowhere, and somehow you invested in there and you invest everything and it's not going to happen anytime soon, and it just went bankrupt, and all of a sudden, that's it. So that's the problem. Their diversification, you put all your money on whatever, and that's it. It's done. It's a bust, whatever. So to avoid that, how you avoid that, right? So it's the reason is a mistake is because like a lot of hype also goes around there, and not enough research, and just you know, maybe a chance kind of situation. But to protect your overall money and portfolio, what you can do is that invest in different stocks or different you know, asset classes. So what I do usually is that you invest in real estate. I invest in the stock market as well. So I got 2 already diversified portfolios, right? So within the portfolio, within those segments, right? So you can do various locations, right? So you can do like the town center or whatever, like you can do other states and stuff, and then you can do the stocks, right? So you can do dividend stocks, right? So that's a very nice one. Or you can do growth stocks throughout, like, you know, regular, like whatever. You can do gold. That's a good one sometimes, you know, like in a situation when like in recent days happened, it was pretty good, you know, investing in gold. So that's the key point, diversification, right? So if you don't do it, you sure thing mistake putting all your money in one stock, whatever, and you know, maybe you will do enough research, and like, you know, hopefully you will do enough research to make it like, all right, it's a sure thing. So remember, so, and that's another situation where it's going there. So to avoid that, try to spread it out, you know, do research throughout the stocks. You can do mutual funds, different mutual funds. That's a good one too, because they spread it out across. So that's a good one. So S&P 500, give you birds of diversification. That's a good one. So that's like just following the market there. So, I mean, to each their own, but diversification is the key that we're talking about. No diversification is a mistake. Do diversification. So mistake number 5, over trading. Oh man, for each is to each their own, right? Obviously, but as I was going through like investing journey and things like that, so I was going through like you can like some good advices that keeping track or trades and things like that. But all of a sudden, at the end of the day, if you buying and selling each and every day, you better make up for the taxes, fees, and missed gains. That would be like key, because taxes, when each time when you do the trade, well, or when you buy and sell, well, when you buy, you don't really pay taxes, right? So when you buy that, but when you sell, technically it's either loss or capital gain. So but thankfully, if we like successful, it's a capital gain tax. So there's a short one, the long-term capital gains, but that's like within the US specifically. So for your region, where you at, like maybe in India or other places. So thank you guys for watching, by the way. Everybody still give a like me. So like, subscribe down below. But in any case, if you do those things in there, so you probably will pay taxes. So you pay in US anyway. So well, when we do buy and sell here, so but taxes, fees, whatever it is there, so missed gains, that's possibility too. So so when you sell or you trade a lot, especially like mutual funds, for example, that's a fee. It will take you a lot, but the approach is there. The whole thing is the approach is what's going on. So that's the key. So if you approach the like trading, like there's options trading, obviously. So that's one of the more frequent ones. Day trading, obviously. So as you might have noticed throughout my channel, I'm not a day trader at all. I'm in the long haul kind of situation, so long money, if you will. So but that gives me more peace of mind, and I know more, like I have more surety that even if a hiccup happened, it will rebounds back, and water under the bridge, so to speak. So there you go. So that's a mistake, but to avoid it, don't do it. Do not trade often, basically. If you in the category, if you prefer the strategy that I'm taking, and like more long type of situation, you're in the value type of game or the strategy in that sense. So over trading is that, like, obviously, so basically think of it. If you trade, you pay taxes, you pay fees, you pay gains. But again, think of it, research it, make sure if you do, well, you're definitely going to pay taxes. So but think of those things, so when you do that, and possibly might lose on the value as well, because market can go up and can go down, but usually when it goes up, you lose it, and then you thought it would be going up. Just saying. So and lastly, mistake number 6. I wrote this, forgetting about the behavior, letting basically greed making a decision. A very interesting example that happened to me not that long ago, actually, yesterday actually. So I saw like a Bitcoin price going back and forth. Good example, right? So it usually goes back and forth. So but a greed happened there. So and for example, like if I would sold it, and I sold it, but then if I wouldn't sell it, it would have lose value. So and it's just the point that I'm trying to say is that fear of missing out can lead to actual losses in profit, right? So basically, if you let the greed decide whether you want to sell or not, that's a very poor advisor, if you will. So and what I'm getting to is that a mistake letting fear and guide you. So to avoid that, smart move is to automate your investment or stick to your rules. That's my God, this is so profound. This is so good. So stick to your rules. And my God, I see sometimes a very good opportunity, if you will, and then I'm going in and I'm trying to get in, and all of a sudden, let's say penny stocks, let's say, that's not my strategy at all. Some people do that, but There are some, like, you know, sometimes there's like on the horizon, there's like the hot one comes in, or a sure thing comes in, and I always have to remind myself about these like aspects, and that's actually can be rules for yourself. And well, let me know which one you guys like in comments below. But for me, like, I have to remind myself, like, hey, that's not up to that goes against your rules. Like, that's it, that's no go. So and I kind of guess like gets me sad a little bit, but overall it saves me time and nerves and everything that comes with it, like sales and buys and nerves and all that. So nerve-wracking is, I gotta say, from that, because of that. So overall, to say, don't do that mistakes, and stick to your rules. That'll give you peace of mind, save a lot of problem and all that. So overall, here's the thing: avoid these mistakes, right? You're missing out, overtrading, no diversification, ignoring power compound interest, chasing hot tips, and lastly, like panic sell. So avoid those. These mistakes is about it's not about like being perfect or anything. It's about being consistent. It's throughout these recent videos that we talked about, is the consistency, right? So when you do those investments, obviously everybody's situation is different, but if you can contribute, at least try, or like, you know, get into that direction. So less you react by the wind of emotions and things like that. So short-term noise, nice one, like, you know, like short thing profit, whatever, and stick to a strategy. Let's say growth and dividends, right? Or dividends only, right? So depending on your strategy, where you at and all that. So if you stick to it, you will have much more results, or much better results, I shall say, but rather than you have like emotional kind of ins and outs. So like, subscribe down that video, like down below. Thank you guys for watching, man, it was amazing. Thank you guys for listening in, and that's all I had. So thank you guys again, and I am out. See you guys in the comments below, or let me know what you think. So, and later down the road, we'll see each other again. So thank you guys again. See you next time. Dimitri's out. Ciao.